Good morning to all. We are delighted to welcome you in the virtual CPE meeting on Internal Audit and Risk Management, being organized by Internal Audit Standard Board of ICI and hosted by Kurukshetra branch of NIRC of ICI. The ICI has been providing continued inputs to its members through seminars, lectures, workshops, technical literatures, e-learnings, web-based trainings, etc. Hence, we heartily welcome you in this VCM on Internal Audit and Risk Management. Before going ahead, I would like to invite CA Deepak Bansalji, Chairman of Kurukshetra branch of NIRC of ICI, for his opening remarks. Over to you, Sir Deepak, sir.
Good evening to all. I welcome our honorable guest, CA Premnath ji, CA Neeraj Basu, Group CFO Blue Star Limited, CA Kamaljeet Khurana, Managing Director Carpet Solution Private Limited, CA Vidit ji, I, CA Deepak Bansal, Chairman Kurukshetra branch NIRC of ICI, extend a very warm welcome to everyone present here at virtual CP meeting on Internal Audit and Risk Management organized by Internal Audit Standard Board of ICI. I also welcome all the members of ICI present here to make this webinar worthwhile. Now I will halt my words and start with the webinar and virtual CP meeting for the day. I guarantee our next few hours will be knowledgeable and memorable. Thank you for being patient audience and hearing me. Let's start the webinar now.
Thank you, Deepak ji. Now I would like to introduce our learned speaker for the day, CA Premnath D. Professional qualification: FCA, DISA, FAFD, Bachelor of Commerce from Shri Venkateswara University, Tripudi, Andhra Pradesh, 1987. Presently, partners Messrs. C. Ramachandran and Company, Chartered Accountants, Hyderabad. Professional works handled by him: internal and external forensic audits of large manufacturing, infrastructure, software, PSU companies. In banking, central statutory, bank statutory, concurrent and revenue audits. Income tax representations, including international taxation and transfer pricing. Design and review of standard operating procedures as a part of SAP implementation audits. Study, review and audit of internal financial controls of PSUs, listed, large manufacturing and private limited companies. Carried forensic assignments of MNCs and large manufacturing companies. Peer reviewer and ICAI FRRB technical reviewer. Training programs, seminars, conferences at ICI since 2000. Regular speaker of e-filing, XML, XBRL, audit under CBS and GST. He's a visiting faculty as well. A regular visiting faculty at Income Tax Department, Staff College, Hyderabad. GST Central and State Government, Hyderabad on GST for Analytics. CAG, Staff Training, Hyderabad. National Institute of Rural Development on Tools and Techniques of Internal Audits. Central Vigilance Officers on Digital Forensics, National Police Academy, Hyderabad. IDBI, Andhra Bank, Indian Bank, Staff Training, Review of Annual Returns from Lender's Perspective. I welcome Premnath ji from Hyderabad. Sir, over to you for your deliberation, sir. Thank you.
Thank you. Thank you, sir. At the outset, I thank AASP for giving me this fantastic opportunity. I thank Kurukshetra branch for inviting me to this. Respected senior members, then Vidit Kunta, and then CA Deepak Bansal, sir. A very warm good evening to one and all. It's my privilege to be associated with Kurukshetra branch. I visited Kurukshetra, a wonderful place. Hence, I would like to start my presentation with a slide starting on the subject related to the Kurukshetra. I think my voice is audible.
Yes, sir. It's very much audible, sir.
So PowerPoint is visible.
Yes, sir. It's visible.
Thank you. Thank you. So let me start with a slogan from the Bhagavad Gita, which is from the place called Kurukshetra. So it is Dharmo Rakshati Rakshitaha, meaning is if we comply with Dharma, Dharma will protect us. In the same way, comply with ICAI code, which is Dharma to us. If Bhagavad Gita is a Veda and it is a code of conduct for human behavior, ICAI code of conduct is for chartered accountants behavior. So if I comply with the ICAI code of conduct, which is Dharma for us, the code will protect the professional and the profession. So since it is from Kurukshetra, I'm privileged to start with Dharmo Rakshati Rakshitaha. So let's move into today's topic, system controls and a role of internal audit. So before that, this is a news very recently appearing in the news headlines, which says the chairman, managing director, executive director, or the senior officials can't be held vicarious liable for the criminal acts of company. This is what Supreme Court says. It is what a long pending case of Karnataka, they have decided it. The reason for discussing this case at this point of time is on the system controls. If the system controls are in place, if the systems are in place, then the director or the top officials can clearly say that I was under the belief that the systems was working well, and the reports made by the internal auditor or the monthly returns submitted as a part of MIS, the returns that are made available to the board and the IFC reports made available to the board, everywhere there was nothing much serious we have noticed, and we are at the helm of the affairs. At the lower stage, what's going on? How can the senior officials like managing director, chairman, executive director will be held responsible for it? The meaning here is if the systems and controls are in place, and if such systems and controls are not adhered to, then it's the responsibility of the top management. But once the systems are in place, then it is at the internal auditor or the managers at the lower level who should take responsibility for its compliance. Having said this, let's walk into various issues. So let's see the internal audits landscape, the complete internal audits landscape. Let us try to understand that. Right from the corporates to which we carry out the internal audit, that corporates will have a corporate objective. From objective, policies come out. From policies, procedures, and those procedures are none other than rules, methods, and standards. And all together, put together, it is called as standard operating procedures. The compliance to objectives, policies, procedures, and rules and methods depends upon the corporate culture, corporate ethical behavior, family background of the promoter, corporate governance, values, transparency, accountability, and so on. So it is not the objectives alone, but the objectives are implemented with ethics. That's what I said, the Dharma Rakshati Rakshitaha. So the ethics are none other than the ethics and morals represent the Dharma Rakshati Rakshitaha. So if the policies, procedures, rules, and methods are in place, but if the culture, background, corporate governance, values, transparency, and accountability are not in place, then the transactions that are recorded, bookkeeping, summation, classification, MIS reporting, compliance to accounting and auditing standards, true and fair presentation, timely preparation will damn get affected because of the objectives or because of the ethical values. Meaning, generally, permit me to say, generally, the internal audit is confined on a larger scale, the internal audit is confined to GST non-compliances, taxes not deducted, cash payments more than 20,000 or 10,000 rupees, and certain small non-compliances or majority part of the internal audit reports comply with. But we should travel, the internal audit landscape travels beyond bookkeeping. It goes beyond bookkeeping. It's not related to, but however, the statutory audit coming to, it's more on the true and fair presentation, complying to the standards. But the internal audit travels beyond, meaning it's the objectives, the ethical, and these transactions are into the information systems now. And today, even a cab operator or a small vendor on the roadside who is selling food today is linked to the Swiggy system of delivery. And cab drivers are linked onto the Ola and Uber. Such kind of integrated information system compliances in a small businesses. And there can't be a business where it is not having a systems. But if that systems, the effectiveness of the financial transactions, the results will depend upon the way the information systems, application systems, system admin, networking, capacity planning, automation, system security, logbooks that are generated, disaster recovery management, data center management, etc., etc. All these issues have a bearing on the transactions. And the compliance of information system, all these information system compliances largely depend upon the objectives, policies, and ethical values. And the other one is environmental, legal system, political system, cultural, economic system, global integration, bureaucratic system, etc., etc., will have a large impact on the objectives, and culture has an impact on all these systems, meaning that each one of these 5 items is so interlaced, and one has an impact on the other. Environmental, legal, political, cultural, economic, global integration, and bureaucratic system has an impact on all the other 4. Similarly, objective, policy, procedures, rules, methods have an impact on all this 4, meaning the internal landscape, internal audit landscape doesn't confine to just bookkeeping, and the auditor needs to consider all these issues into account. More than that, even the management should be able to consider all this, and only then the internal audit function has a value addition. Otherwise, it is confined to audit committee paper compliance checklist, nothing more than that. So having said that, having said here about the ethical culture, family background, etc., etc., having said this, now look at the board structure, how it needs to be. And a board system typically should be interlaced with, you can just see here, the audit committee and supervisory board, board of directors, nomination committee, compensation committee, executive committees and representations, divisions, auditing, operating companies and all. And if such kind of systems work in place, then the internal auditor has a role to look into all this. It's not just confined to the bookkeeping. Hence, I said it's a broad ethical values which will make this kind of system to work not on the paper, but on letter and spirit. Now, coming back again, having said about the information system management here, having said about the information systems, these information systems landscape will look like in this manner. Meaning, our topic is on the information systems and internal audit. Our topic is international information systems and internal audit. And just look at the system management spectrum. It goes into application life management, application program management, and system management, system administration, automation, workload, asset lifecycle management, log analysis, performance management, system security. All this has an impact, and that's the reason why I've just put it here. it is not only the culture of corporate, it's not only the accounting system, it has all to be taken into account. Having said this, let's move on into information system. I've already said it. I'll just skip this. And impact of the technologies today. And the technologies that are ruling around today are mobile, cloud, digital service, big data, social collaboration, blockchain, artificial intelligence, machine learning, IoT, payment system, cyber security, robotic process. All these processes are in place today. If you can just look at Swiggy or Ola or Uber system of working, they work on a mobile phone. They work on a mobile phone, and these mobile phone apps are on the cloud, and these clouds have a digital service, and these are all working on a big data, like the transportation, the Swiggy or Ola or Uber. If you can just log in, you can once you are boarded and placed an order, you can track to what extent he has come, how much time it will take to deliver. Meaning those are all with big data analysis and artificial intelligence, IoT, social collaborations, blockchain technologies, artificial intelligence, all these things we are using all these as a customer. Now I say it is high time that the auditors need to use this for running their businesses. But we are all using mobile, but we are using mobile as a end user. But I say that these needs to be used like a Ola cab driver and the Swiggy delivery boys, how they are using these systems in the same way. Our officers needs to be equipped with these. And not only this, even the businesses also needs to embrace into all these technologies. Otherwise, competitiveness and survival will be at a big stake. Coming into, so what are the statutory compliances? What are the statutory compliances that are forcing us to go into internal controls? So Section 134 of Companies Act clearly mentions about the functions of internal audit, and that are none other than the internal financial controls. It says Section 134 says it has to comply with the internal financial controls for order and effective conduct of business policies. This is what I said. Business policies, safeguarding of assets, prevention and detection of fraud and error, complete and accurate accounting record, and timely, reliable preparation of financial information. I'll just go back to the earlier slide. Having said this 134 section, this is none other than Section 134. It is talking about the board. It is talking about the policies. It is talking about the accounting transactions. It is talking about the information systems protection. It is talking about the legal compliances with that. And this is none other than Section 134 of Companies Act is what is written here, meaning that the internal auditor needs to ensure the compliance to this 134. Yeah. Having said, what are these internal controls? The internal controls are essentially risk mitigation steps, meaning control and risks go together like debit and credit in accounting. The moment I say debit, the other one comes out automatically is credit. In the same way, in the audit language or in the management language, when you say there is a risk, there needs to be a control, meaning like a debit and credit, control and risk will coexist. So why this control? To mitigate, why this controls? To mitigate the risks taken to strengthen the organization system processes. What processes? The processes I have just listed down, for example, are procurement to pay, the total purchase system, the total sales system, total fixed assets building system called as WBS in SAP or ERP. It is called as work breakdown systems, material management, inventory management, fixed asset, FICO, and so on and so on, HR, and so on and so on. All these system processes needs to be strengthened to help to prevent, detect errors and irregularities. That's the reason of information system controls. I'll take a few of these within the given time. Then it says internal controls per se. What are the controls? Controls are detective, preventive, first preventive, then detective, then corrective, and compensating. I'll take the help of certain screenshots in ERP, maybe it is SAP or so. I'll talk about what is preventive, what is detective, corrective, and compensative. What happens if these controls are not there? And in the same way, when IC, when internal controls mitigate operational risk, those are all called as operational controls. And now it is all with the automated environment. That's what I said in at a very lower level called Swiggy and Zomato and Uber and Ola, where if such kind of small cabs are using the technology, then bigger companies do have automated. And we need to look into IT general systems and controls. This is what will go into very depth, into one by one. Then different types of controls, as I've already covered this, I'll go into very detailed when I look into the screenshots. So internal audit function, as I've already said, I'll just read out quickly. Internal audit is an independent management function which involves continuous and critical appraisal of functioning of an entity. And remember the internal audit landscape, I have put it, with a view to suggest improvements thereon, meaning improvements where? I'm saying entity and to the improvements, and add value to and strengthen and overall governance mechanism of the entity, including entities strategic risk management, internal control system. Therefore, internal audit therefore provides assurance and there is transparency in reporting as a part of good governance. So as of today, internal audit undeniably is a backbone of sound corporate management system. I'll again go back, having said about governance, having said about risk management, having said about value addition, having said about various processes, I'll again go back to the landscape. And this is what I'm saying. The internal audit looks into the objectives, culture, bookkeeping system, and advising on the legal system, political, cultural, and integrating those business policies and so on. And this is what it is again said in about the internal audit, where we are trying to create a value addition, unlike statutory audit. So if we can quickly look into the Companies Act provisions with respect to the internal audit, I have already stated about the 134(5), and then 143, which is again talking about internal financial control system that an auditor needs to report. And section 177, audit committee needs to apprise on the board's functioning about the internal audit. 149(8) also talks about independent directors abide by schedule 4 of the said schedules have been put on onus on the independent directors to satisfy themselves about the financial controls. Then most important, this is what I would like to bring it here, emphasize more, that section 262 subsection 60, officer in default includes key managerial persons as per section 2 subsection 51. So KMP has increased the maintenance, the compliances to the internal controls. And this is what I have said. This is where the Supreme Court judgment on vicarious liability on the directors and all, they are just trying to get out by quoting these, because it is the internal audit, be that the internal auditor, be that the key managerial professional, be that the CFO or CEOs, they are at the top, and next comes the directors, and hence compliance to the internal audit plays a dominant role. Let's move on into the practical examples now. So in one of the corporate, a very big corporate, the compliance to the SAP and GST, I've just tried to put it into a small flowchart. The transactions that are recorded at various locations by different users, inward supply and outward supply with respect to the GST, then those things form into ledger, trial balance, financial statements, ROC forms, GST compliance, and IT, income tax compliances. Now, presently, the GSTR 3B and GSTR 1 is prepared without a predefined formats by using ZGSTR. It is a report which is generated from the SAP. And ITC is not captured, and it is also not properly availed in the present system because the reporting system is not proper, because the SAP configuration is not proper. And that's what I said, due to SAP configuration issues, GST compliance is presently carried out manually without a predefined set of processes. And this is leading to mismatch in various reports that are presented. And how it is done. if I can look at the procurement to pay process in SAP for that particular company, there is an agreement. From the agreement, the tax codes, the tax codes are not properly put into the SAP. Purchase material or purchase requisitions are not properly fed into the system. Purchase order processes are not properly entered. Manual GL code entry, defects in tax code designing itself, there are errors in this. Then invoice generation, there are errors in this. Then vendor aging reports are not maintained. And these are all the configuration issues in procurement to pay in SAP. And this is resulting into an impact where it cannot identify because of the aging report is not properly done, because the tax codes are not properly assigned, because the purchase material or material requisition or PO order processing is at defect, or the invoice processing is at defective, then it is resulting into ineligible ITCs. There is no maker and checker. Nature of transaction cannot be identified since the service code or GL relevant codes are not properly done. There's a lot of mismanagement. There is a lot of misreporting, which is resulting in huge liabilities towards the GST. And if this is an agreement, a lot of issues like the agreement has a value. Agreement has a value here, and which is not entered properly here. And agreement also has about the GST, including GSTs. But while GST is selected as a tax code, which is not being properly held, and moreover, the withholding tax rates are not properly assigned, and then the total controls are not moving on in a standard way. And you can see here the credit availment rates are not being properly defined here in the system, and because it is not properly defined, the reports that are generated are erroneous, returns submitted are erroneous, taxes paid based on the returns are erroneous. Meaning, the point what I'm trying to highlight here is, as an internal auditor needs to ensure, internal auditor needs to ensure the system compliances and legal compliances. Coming back again, the withholding tax codes are not properly done here. The TDS tax codes are not properly done, meaning that the system has a capability to capture, but which are not captured properly, meaning that one can understand the cost of SAP. The cost of SAP is almost 2 lakhs per licensed user, when yearly 60-70 lakhs of amount is spent on SAP, and which is not being properly used. At the end of the day, the controls, the purpose for which the system is put on is ineffectively used. These are all the part and parcel of internal auditor's role to comply with. And this is what I've just mentioned here on. Moreover, SAP, any accounting system, on the top layer, you have various processes going on at the top layer, and somewhere in the middle layer, you have the accounting entries configuration. So I have my experience is we have seen the SAP is used more of an accounting configuration rather than the total business process compliances. Meaning, if a corporate is spending lakhs of rupees only to just generate accounting records, then the total system is misused. So the point what an internal auditor needs to look into is, as we have seen the total landscape of internal auditor, he needs to look into whether the ERP system is capable of talking about the policies and procedures, ethical issues, transaction processing, information system controls, and the environmental issues. The internal auditor needs to look into whether all these things are properly captured into, and not only the accounting setup. Let me just take you through the screenshots where you have all these processes. So having said here, the implications I've said, whatever I've said, I've just reported here. Now going back here, because the data captured is at fault, the reports that are generated is also at fault. Meaning, when the SAP system or an ERP system is not properly capturing the data, the reports that are generated by the SAP is also at fault. Once the reports generated is at fault, is at inaccurate, then the decisions that are made on the basis of the MIS reports is also wrong, and the purpose of business objectives will not be achieved. Meaning, an ERP system is put into place, enterprise resource planning system is put in place for effective decision making, timely decision making. ERPs are not limited to balance sheet machines. ERPs, the balance sheet is at the last part. Incidentally, an ERP will give a last part of document that is called as a balance sheet. But most of them are using ERPs as a balance sheet machine, but it's not a balance sheet machine. It should be used for effective planning, and that is the objective of an internal auditor. And hence I say the ERP's configuration plays a dominant role in that. I repeat again, if the ERP system is capturing information and providing a timely information, and that timely information is management information system, if timely, accurate information is provided, good decisions are made, and that will definitely lead to the objectives of business. And having said here, you can just look at the purchase order processing. You have so many tabs here. Most of these tabs are not adhered to, resulting in a lot of inaccurate data being produced. And hence, if the information system is insufficient information system is insufficient because these data are not fed into for proper controlling. If these data are entered into at appropriate time, that is preventive control. And once it is entered into properly, then if there are any mismatches, if there are any discrepancies or discretionary powers are used, then those discretionary powers needs to be tracked with a detective system called with exceptional reporting. I'll come back to that a little later. But the point is, you have so many tabs to be filled in, but not filled in, creating inaccurate data. You can see again here, a lot of data can be, you have multiple tabs. Under this tab again, you have multiple tabs of data to be accounted. And you also have an accounting assignment here. This is what I was referring to. The SAPs or the accounting most of the time are bothered about account assignment rather than all these processing. And you can see here still there are so many tabs to be given here for effective management, but it is only limited to account assignment compliances. And this is not only the SAP, even a small package like Tally is used only as an accounting, though in Tally you have procurement to pay, order to cash, fixed assets maintenance, HR compliances, GST, income tax, so many compliances are there in Tally, but Tally is used only as an accounting assignment. That's where the auditors are not in a position to create value addition as a part of internal audit. Coming back again, if say for example, if I'm able to buy, if I'm through a purchase order, if I am buying some goods or equipment or machinery, if I can design at the stage of purchase order itself, if I am able to link it to a proper accounting, whether it's a receipt, whether it's a repairs and maintenance, or it has to go to the fixed assets. If I can able to configure here, the moment I am able to configure this here at the purchase order stage, at the later stage, when the material is received and the payments are made, the system will automatically assign all these things, and the accounting entries will become much reliable. And that's where the internal auditor can focus more on the other issues than on the accounting issues, because the accounting will become automatic because of these compliances. Coming back again, once you are able to select a particular item and assign it to a WBS element. WBS element is work breakdown structure. This is more important to building a fixed assets. When the factories are in implementation, when the construction work in progress is moving on, when so many purchase orders are raised, when purchase orders are raised, when it is assigned to a particular WBS element or a capital item, let it be plant and machinery or a particular plant or a particular building or a particular equipment, then at the purchase order stage itself, if you are able to do it, capitalization, which is consuming more number of hours for the management, and for the auditor also, this consumes more number of audit hours, manpowers. It can be drastically reduced, and more amount of suggestions and value addition can be given with respect to this. These are all certain system controls which we can put in place. And coming back, I'm just talking about the various tax codes where this is a tax code. If these tax code under the invoices is properly placed at the purchase order stage itself as an invoice plan, under, you have seen, we have discussed very things in the account assignment and invoices and all. Once you are able to structure it here, then we can see that the GST filings will become automatic, and this will match with the GST and records, and it will also match with the external agencies records properly. And these are all certain compliances, these are all certain configuration issues, these are all certain system issues which needs to be properly done for an effective internal audit or for an effective management control. And these are all various procurement to pay issues here. Home purchase requisition, sourcing and contracting, request, goods receipt note, supplier invoice, payment, and so on and so on. If all these things are done, we are only bothering about whether the inventory is hit to the inventory account and debtors account and closing stock account, but there is much. Once all these issues are then that is a place where an internal auditor can play a larger role. So once you are able to fill in all this, data, the kind of reports that you can generate here are delays in purchase requisition, delays in purchase order, which has an impact on stock levels, reorder levels, shortages, excess inventory. All these things can be planned. And once you are initiating the material resource planning, automation triggers and all these things will be useful as a preventive measure rather than a detective, meaning prevention is better than cure. And hence these controls, what we have said here, these controls, once you are able to use all these tabs and fill the data at the purchase order stage, you can probably minimize a lot of frauds and errors, and you can have a effective control on which is the objective of management. Not only that, you can just see instances of purchase requisition approvals. Purchase requisition is put, but you find here even 200, 300 days of delays in approval, meaning it talks about the culture. It talks about the compliance culture. It talks about the policy culture. It talks about the way in which the management is working, board is working, CEO working, CFO working. Based on these, an internal auditor can make a lot of value addition. Then coming back to, from PR to PO conversion is taking a lot of days, meaning that the system is not effectively working, meaning that SAP is underutilized. And then orders are raised, but materials are not attached to the orders. And then what's happening is manually they are entering data, whatever is coming is entered, and they are not properly linking the material to the orders. And in that case, there can be a lot of frauds happening. And system configuration and preventive issues will be cannot be controlled, and you can see unauthorized purchases being made. Risk of theft of pilferages of materials can happen if materials are not linked to the material orders, and if it is linked, then it will work as a preventive order. And illustrative list where POs are raised after the material is received, and this is a very bad control. And that's what I said. It all depends upon the management. It all depends upon the management culture. And going on towards, there are a lot of POs are given, but they are not closed. And a lot of POs where it is pending, no action is taken on it. Then again, vendor master maintenance. While the masters are created, MSMD, we all know that the small and medium enterprises compliance is not noted into the system, and this will give an inaccurate particulars on the financial statements, and this is also penal consequences are there. if we are not complying with these effects. And we can see because the vendor master controls are not proper, you find a lot of duplication in this. When there are duplicate, it will lead to a lot of errors, or it may lead to a lot of frauds. And supporting documents are not maintained in the companies. And material master maintenance controls are not properly, wherein we can see here the same material, different codes are given, meaning this can be used by an intelligent person to place orders under these different codes. And we can see here so many codes are created, and there is no control, there is no preventive control on this. All these things will depend upon the centralization. All these things will depend upon the policies, procedures, rules, methods, standards, and the culture. When you have your materials being purchased at various rates, once you are able to properly do it, we can see here same material is purchased at different rates at different time. The same material is bought at different rates at different time from different customers. And this is happening because though the materials or management is maintained, but the preventive controls are not in place. If preventive systems are not there, it should be able to come out with a detective system. Detective system is all depends upon the way in which the MIS reports are prepared. And so in the absence of periodical review of user accounts reports in the ERP, this is what I said, the log systems, then user unable to find whether the segregation of duties are properly done, meaning that some errors are creeping inside. Whom to be pinned, we can't do it if you are not able to do it on a proper basis. That is, if the log system is not properly done, detective mechanism will fail. Then absence of system configuration to restrict procurement, even if the stocks are already existing, that is a preventive control. And there are so many other examples here for other systems. I just quickly run through because of the paucity of time. Now, the role of internal auditor. The role of internal auditor is the audit approach. This is the way in which we carry out the audit approach, audit planning, where I said you look at you can recollect the first slide where I said the landscape. So audit planning needs to be considered into business management concerns, business industry risks, past audit, and then schedule a plan. Then again, standardize communication, quality controls as per the auditing standards, and reporting and analysis with technologies and all this. This is the total process of audit. I'll not spend much time here, but the heart of it is compliance and substantive test. What is compliance test is compliance procedures around ERP. Read this CBS as ERP. Compliance procedure is what I have now talked about, the controls around the ERP in various screens and the assertions made. We need to check if the compliance controls are poor, if preventive systems, detective systems are very poor in the compliance procedures around the ERP, then an auditor needs to carry out a lot of substantive procedures like inspection, observation, inquiry, confirmation, recalculation, reperformance, or analytical procedure, or assertions and ROM, and so on and so on. All these procedures will enhance if these compliance procedures are poor. That's what we have seen. That's what just now we have seen. If the SAP systems are not properly in place, then we need to carry out a lot of procedures. I'll just take you to one simple procedure. Yeah, I think I'm able to share one Excel sheet. Can someone confirm that I'm able to share the?
Yes, sir. It's visible, sir.
You can just see this is a big dispatch report, and in that transport related data is available. From this transport related data, the complaints that we can verify, we have seen as a substantive procedure, we have seen as a compliance procedure, we have seen that the TDS compliances are very poor. If compliance procedure is poor, compliance procedures or system controls are poor, substantive procedures needs to be enhanced, meaning with respect to the transporters, if the transporter gives a declaration that he is not having more than 10 lorries, then TDS needs to be deducted. But looking at the lorry numbers, you can find out how many lorries he has and why TDS is not complied to him. Like I can say here with a pivot table, I can say that these lorry is used by the same lorry is used by 2 transporters and so on and so on. And you can find here the same lorry is used by multiple vendors. Meaning whether can I rely on this dispatch report, whether I can rely on the dispatch report. This data is giving some kind of professional skepticism. If there is a professional skepticism, I need to inquire more and try to ensure that there is no fraud or error going on. And you can also see here, the PAN number is allocated to more than one party. The same PAN number is used by multiple vendors. Multiple vendors are using the same PAN number, meaning that the validation controls, which is a part and parcel of preventive controls, is failed here, and hence, because the compliance procedure is failed, I need to carry out a larger substantive procedure in terms of scrutiny. The TDS compliances, the PAN number compliances, if PAN number is wrongly given or not given or erroneously given, probably you may have to deduct a higher rate of tax, probably you may have to pay a penalty and so on. So many consequences which will result in loss to the management, and hence I come back to the same PAN number, the status of PAN number. We can see here this letter, fourth letter indicates the person. Now you can just see here some PAN numbers are entered, but the system is not validating the PAN numbers properly. Sometimes it is less than, sometimes also it is less than, you can see here 9 number PAN digits are entered into the system. 11-digit PAN numbers are entered into the system. I'm just taking a very small example of a larger data entry system, a larger information gathering system on an ERPs. If validation controls are poor, garbage comes in, and garbage goes out as an MIS report. If garbage goes out as an MIS system, then the report, the decisions that are made on the garbage will also be an ineffective decision making, and the value addition will not be carried out through the information systems. And can I continue for a few more minutes, or should I stop?
Yes, sir. You have time till 7, sir. You can continue for 15 minutes.
Yeah. Okay. Good. Thank you. So coming back to the compliance procedure, I said compliance procedure. So what is compliance procedure? Which standard talks about SA 315 for the statutory audit, and in the same way, statutory internal audit also has a similar auditing standard which talks about the SA 315 material misstatement. So the material misstatement can happen. I need to understand as an auditor, as an internal auditor, I need to understand the material misstatement through understanding the entity and environment. The entity and environment I need to understand as a part of SA 315. Remember, SA 315 is the mother of internal financial controls. So this is the heart of all the auditing standards, be that internal audit or external audit. And understand the business, understand the legal and governing regulations which is impacting the business, understand the accounting standards, understand the technology, and only then I can draw a proper audit plan. And Let me just take you back to the same slide again, which I have started here again. The same slide I'm just taking here. SA 315 covers a whole lot of issues. All these issues come under SA 315. I repeat again, I'm just talking about only 3 important things all along this lecture. I'm only talking about this 5 issues, only talking about these 5 issues. And This information system, process capturing, and the accounting system I have demonstrated through various data screens. And this is impacting because the objectives, policies, and procedures which need to be followed by the management has a low ethical, low culture, low corporate governance, values, transparency, and accountability. Because these are very low, the objective, policy, procedures, and rules are only confined to the balance sheet finalization and submission. If this is strong enough, rest of the things will work very well. Having said this, let me go back to BSA 315. Yeah. So this is what I said here. So once I have a business understanding, then I can understand what can materially go wrong. Once if I know what can materially go wrong, then I can make a suggestion to the management. And not only that, there are so many laws and regulations governing the business environment. Let me just share one small Excel sheet which talks about so many laws and regulations that needs to be governed by a small business entity. Just a second. So I'm just trying to demonstrate the various legislations that are affecting a small cement company. I'm just trying to, for a small industry. You can just look at the number of rows. You can find here the amount of compliances that a company needs to do, which is in mining, processing, manufacturing related. There are 2,191 row items needs to be complied, and those are legislation, the compliance header, whether it is. Let me just try to put a filter here. You can just see here what are all the things that needs to be complied with here. Like it is related to abandoning of mines, abstract, accommodation, meeting, acknowledgements, then additional director, so many things, maintenance of accounts, procedure where partners is dissolved, submission of returns, like this under various acts. What are the compliances to be done? Various compliance description, when it has to be done, the event based on, is it an ongoing or is it a time based? Is it one time affair? And then compliance frequency, how often is it, a half yearly or a monthly or a quarterly or a yearly? Then which Bayer Act it is talking about? What are all the Bayer Acts it is talking about? And what are the penalties if not complied with? And this is penalty description and default date, proof of compliance for the management, and approval required and active, and so on and so on. The reason for demonstrating this is it is coming under the legal system. This is what I said in my landscape, the auditor's landscape, which I have said, the auditor's language, landscape, which I have shown. It comes under compliances, and you have seen here 2,191 lines of compliances of various enactments. All these things comes under the role of internal auditor, and we need to see as an internal auditor, and we also needs to ensure that the systems are well in place and the systems are in place for regular governances, and those systems and ERPs are well integrated with the laws and regulations. The systems are well integrated with the accounting. The systems are well integrated with the business processes. And only then I, as an internal auditor, can talk about what can go wrong and risk management. Now, the role of internal auditor, if the systems are fully implemented, the systems are partially implemented, and the systems are not implemented, then we need to find out. If systems are fully implemented, what happens? If the systems are fully implemented, I mean that the preventive controls are sufficiently in place with 90% of controls, 90% of detective controls, 90% of corrective and compensative controls are in fully automated. In a fully automated system, value addition can be given by an internal auditor by looking into the regular updates to the system and so on. And whether, if I say that the purchase order system is in place, like I say, in the reports what we have seen, there are so many parties who doesn't have the GSTN number. There are so many parties who doesn't have a PAN number. Now, if it doesn't have, meaning that the internal that the control system is not validating that particular field. Because it is not validated, there is a risk in that. So when there is a risk, how to detect? The risks can be detected by generating the reports. When these reports to be generated, how often these reports to be generated, depends upon the policy and procedure. Now, say for example, if it is partially implemented, then if the preventive controls are very poor, then that is what I said, the preventive controls are partially implemented, then it is the compliance procedure is poor, then the detective mechanism has to be increased. The detective mechanism increasing means lot of reports needs to be generated. If the reports that are generated from the MIS, because the complaints are poor, I may not able to rely the detective controls. If I am not able to rely on the detective controls generated by the reports, then I need to rely on the external data. Meaning lot of work has to be done from the external data. When I look into the external data, like I have to rely on the PAN number database or GSTN database or various databases that are available outside. I need to take that data and validate those data with the data that is submitted by, that is presented in the ERP system. And based on those things, the internal auditor can give various value addition in terms of preventive controls. If yes, if the controls are not implemented, then there is greater work that do, and the internal auditor also has to carry out. And so I've just put here, because of the paucity of time, I'm just not reading out. I'll anyhow share the presentation to the AASP. From there, you can source it. And further, I've tried to say, what if the systems are fully implemented, like say, for example, a credit limit for a customer is fixed, it is implemented. But once the credit limit is fixed, there is always a chance that the officer may use his discretionary power and enhance the credit limit. When he is enhancing the credit limit, then there needs to be an exception report generated. And these exception reports needs to be called as an alerts, and these exception alerts, like say for example, if a building, you have a preventive measure, you have put on so many preventive measures of fire preventive systems you have taken place. But in spite of all these fire preventive measures you have taken up, there can be a fire coming out, and this needs to be alert at the right time, meaning there needs to be a sensors. Yes, sensors are also in place. The sensor is giving a buzzer or an alarm, but it is giving an alarm in only a place where there are no people living. And if that is the case, then that's not a disaster, that's not an exception, that's not an alert system, meaning that if a fully implemented systems are in place, there needs to be an exceptional reports, and exceptional reports needs to be generated for every kind of discretion used. And those exception reports should be in the form of an alerts, and those alerts should be in a form of taking a proper action, and those actions needs to be escalated to the higher and higher authorities for a timely behavior. And only then, and these are all the value additions that an internal auditor can take up. Partially implemented, yes, lot of validations using MIS reports in Excel, perform reconciliations, subledgers to TB, check whether alerts are properly made in case of deviations. Not implemented, there is manual vouching, manual verification, Excel techniques, and suggest to implement suitable ERP systems in place. And this is what, in every place, an internal auditor has a role to play and a value addition to be created. Then what are all the how an internal auditor can give more efficient systems is, like say, if the system is well implemented, then based on the cash manage, Internal auditor can give cash management and treasury operations based on the receipts and payments data. What can be the cash retention limit? What can be the cash insurance? What can be the level of cash that needs to be maintained at various levels? Whether cash needs to be maintained on a daily basis. Why can't the cash disbursements be made on a one day in a week, Such kind of things will increase the treasury management and reduce the interest liabilities and efficiencies and so on and so on. Economical vendor evaluation based on the freight data. If you have so many freight data, so much of freight data, probably which lorry owner or which logistics supplier is able to make an effective data. Then improving contract terms and conditions based on analysis of various data from procurement to pay reports. If you can just take out and you can find out whether the delivery is properly done, whether quality is on time, quality is done, quantity, time, payment, etc., etc. By analyzing these reports, you can suggest how terms and conditions of memorandum of understandings and all can be structured. These are all various value additions that an internal auditor can make. And there are various long pending deposits sitting in the balance sheet years together, which are not reviewed. There are no preventive control, there are no detective control, no controls at all, where an internal auditor can say these are all the contracts which are terminated, but there are still rental deposits, retention deposits, and so on and so on and so on still going on. These are all various issues you can highlight as a part of internal auditor. Having said all these things, coming back to the very first slide again, I say we have started with Dharmo Rakshitaha, meaning that if you comply with the code will definitely protect us. And this is not only to the chartered accountant, but also to the management governance. Management governance should comply with the policy, procedure, rules, and methods. Moreover, this ethics culture, everything, it is not to the corporate alone. This equally applies to a chartered accountant who will put on the chartered accountant firm's policies, procedures, rules, and methods, chartered accountants' methods of carrying out information systems, and so on, will definitely give a value addition to the business community and to the profession. Thank you very much for your patient listening.
Thank you, sir, for such an amazing and nourishing deliberation on the topic. I believe that every participant who listened to your presentation today has learned about the new dimension to this topic. The way you explained about the internal audit landscape of 5 issues, including that about its connection with AS 315 and all, IFCs and all that. The issues with respect to audits using the Excels, we get that practical aspect of it, of the issue as well. Thanks a lot, sir. I hereby present a vote of thanks to Premnath sir for sparing his valuable time and teaching us to the best of his knowledge. Thanks a lot, sir. Thanks a lot. Now I would like to move on to the next part of our session. I would like to introduce CA Neeraj Basurji, eminent faculty for the day. CA Neeraj Basurji is a chartered accountant, company secretary, and a certified risk professional IRM UK, with around 3 decades of industry experience. Currently working with Blue Star Limited as their group chief financial officers, also overseeing legal compliance and secretarial functions. Before he took his role with Blue Star in July 2014, CA Neeraj was in the role of Chief Financial Officer with Max Bupa Health Insurance since its inception in 2008 and played a crucial role in preparing Max Bupa's strategic and financial roadmap as their founder team member. In his previous stints, CA Neeraj has worked with Max India, HCL Technologies, Spice Telecom, and Escorts, and has handled responsibilities involving investor relations, M&A, fundraising, risk management, and financial planning. Neeraj also joined the board of Integrace Private Limited as an independent director in April 2019. His professional areas of expertise and skill includes value creation through strategic ROCE improvement, business strategy development, enterprise risk management, fundraising, QIP, private equity and debt, governance and ethic frameworks, talent developments. On the personal front, CA Neeraj ji is married and has 2 sons. In his leisure time, he likes to travel to places where he can be close to nature, read and spend time with his family. Sir, over to you for your deliberation, sir.
Firstly, thank you very much, Vidit, for this so generous introduction. And I thank the Institute of Chartered Accountants and IASB for having me today on this such an esteemed panel. And I was listening to CA Premnath ji. It was a wonderful insight that I got. So the topic that I plan to talk about is around integrating risk management and internal audit. So that's the theme of the discussion that I will have for the next 30 or 35 minutes. I joined this session today as a custodian of enterprise risk management, because that area is core as far as my deliverables are concerned, not just in my current role in Blue Star, but also in my earlier role in my previous organizations. And I also, present to you myself to you as a customer of internal audit. So mostly I've been, playing the role of a custodian of risk management as well as a customer of internal audit. And this role becomes quite, essential and critical in the context of, the fact that there is always expectations from the board. There are expectations from the audit committee and various other committees, and how, these expectations need to be managed and handled. So what I won't have a presentation. I will be talking through mostly, my thoughts. So I was just reading through and applying my own thoughts on what is the role of internal audit before I get on to risk management. And again, like I said, I'm speaking more as a customer of internal audit. The way I see the role of internal audit is, first I'll refer to the definition that's given by the Institute of Internal Auditors. It says the mission of internal audit is to enhance and protect organizational value, and I underline these 2 words, organizational value, by providing risk-based and objective assurance, advice, and insight. So it's a very short mission, 2 lines of mission statement, but highly impactful with, like I said, emphasis placed on organizational value creation as a mission of internal audit. And also in the same context, my own sense about and my own experience or expectation from internal audit has always been that, the internal audit's role is to provide independent assurance that the organization's risk management, governance, and control procedures operate effectively. So by and large, this is what internal audit seeks to deliver and add value in terms of the core role. And like you've seen, the risk management and internal audit go completely hand in hand. There's a huge degree of complementarity in the roles, in the deliverables of risk management. Now, coming on to what is the mission, or what is the core deliverable of enterprise risk management. And I refer to COSO 2017 framework here, because I find that framework extremely powerful. Of course, there's an ISO 31000 as well, but for my discussion, I refer to COSO 2017. The role of enterprise risk management, or the core deliverable of enterprise risk management, is articulated as integration of strategy and business performance. So enterprise risk management seeks to integrate strategy and business performance. Now, if you see the 2 sets of governance pillars, I call them, enterprise risk management and internal audit, there is this degree of alignment, and there is the congruence is to do with value creation, performance enhancement, performance achievement in the context of strategic objectives. So that's where this entire subject becomes quite relevant, important, and interesting. Now, when we look at enterprise risk management, what is that we are aiming to deliver to the enterprise, to the organization, or what should an effective enterprise risk management platform deliver? So first and foremost, it is to do with increasing the range of opportunities. So when we're talking about risk management, it is not just always about risk management in a manner where we are looking at either transferring or avoiding or just even just not dealing with that risk. A lot of risk management and a lot of enterprise level risk management is to do with pursuing risk, which is an integral element of COSO's framework, which is nothing but about the opportunities. So a robust risk management framework does provide a range of opportunities that a company and entity can look at pursuing. Second one is to do with identifying and managing risks entity-wide. So the whole core focus is to make sure that risks get identified, risks get managed, and risks get dealt with at a portfolio level, at an entity level, at a portfolio level, of course, also at a sub-function level. But the core, the holistic perspective here is to have an entity level risk perspective. The third key objective of a good ERM platform is to increase positive outcome, to deliver outcome in such a way that it's generally positive, and at the same time reduce negative surprises, because whether it's the shareholders, whether it's the board, no one likes surprises, no one likes to be surprised. And if an enterprise risk management platform, a framework, is working effectively, it will amplify positive outcomes and advantages, and it will help at least give early warnings, early signals, early trends on possible potential any negative surprises. So it won't come as a surprise; it will come as a lead indicator or as an early warning if it is working effectively. The fourth objective of enterprise risk management is to reduce performance variability. Now, what do I mean with this? Performance variation with respect to targets, with respect to goals, budgets, plans. Of course, no one likes to have a significant negative variability or a shortfall or a variance where the targets are not getting delivered, because the entity would have organized resources, would have set up infrastructure, got people in place and invested, and then a negative variation is something that is undesirable. Obviously, that's going to be a drag on the returns. Equally, a variability which is unplanned on the positive side can also be damaging when it comes to organizational strategic objectives are concerned. And let me give you an example here. So let's assume, and I take the example of my ex-company Max Bupa, which is into health insurance. Now, we wanted to make sure that we roll out the business pan-India. But for a health insurance company, it's very important to have tie-up with hospitals in every city, every town, every region. So what we learned very early on, that we started selling policies, say, in a state where our hospital coverage was insufficient, and the core value proposition is like we'll give you a cashless hospitalization. Of course, policyholders can go for reimbursements, but no one prefers that. Now, even if we were overperforming, we were delivering more policies than probably what we thought or our plans, in case we lagged in our ability to tie up with sufficient hospitals from an operating standpoint or patient care standpoint, that could become a risk, because it would lead to possible dissatisfaction and even failures in terms of complying with regulatory obligations in terms of the deliverables. So variability on performance, it can work both ways, and a very effective risk management platform helps reduce performance variability. So that's one of the key outcomes. The fifth one is, this helps to improve resource deployment and basically optimize resource deployment, because all said and done, the resources will be always limited. And it's very prudent to make sure that resources are deployed effectively. And again, the entity doesn't run a risk of inadequate resources or excessive resources sitting idle in any pocket. The sixth and the last one is to do with enhancing enterprise resilience. And we all have experienced enough and more environmental reason to test this out over the last 2 years, ever since the pandemic hit. Enterprises which have been fairly mature or fairly progressive on enterprise level risk management frameworks have demonstrated sufficient resiliency in the last 2 years. And there's a very close linkage with how effective risk management and a pandemic, like, even if it was a black swan event of sorts, but if there was good resiliency in the DNA of the entity, we have seen a V-shaped recovery, as we're calling it in some ways. So these are the attributes, or these are the essential deliverables of an effective enterprise risk management framework aligned with the COSO guidelines. Now, how do the two get connected? Let me now cover that part. Risk management, as the definition states, the risk management integrates with strategy and business performance management. So risk management plays a very vital role in strategy selection and strategy delivery, strategy execution. And an integrated internal audit with an effective risk management framework enhances the strategy delivery and its outcome. So that's how the integration starts to make sense. That an internal audit, if it is integrated very effectively with the enterprise risk management framework, and it is vice versa also. So when I'm making this statement, I also equally mean that integration of risk management elements with a very robust internal audit plan or internal audit framework, it's a two-way flow. So this is one perspective. Both the pillars of governance put together, they come together very nicely to enable deliver organization value, or to enable the organization achieve its strategic outcomes, strategic objectives, and optimize, enhance business performance. So that's one dimension of what I mean by integrating risk management and internal audit. The other dimension of what I mean by integrating risk management and internal audit is to do with vigil mechanism. Now, this is at the heart of every entity's governance philosophy or governance framework. I will show you just one slide, and I have only one slide to show, and I'll talk about it, which will show you all what I mean by this vigil mechanism. So I'll just share my screen and I'll walk you through this particular framework, and then I'll talk about it. Okay. If someone can you please confirm whether my screen is visible?
It's visible, sir. It's visible.
Okay. Yes. Yeah. So now, what is this vigil mechanism framework all about? Yeah. You see, vigil mechanism as enshrined in the Companies Act, and also for listed companies in the LODR, the listing regulations, can be understood. At the heart and the core of vigil mechanism sits enterprise risk management, which kind of minimizes the impact of a variety of risks on capital, earnings, and strategy, and also the internal financial controls. The last speaker, CA Premnath ji, also talked about it when he was talking about that one particular auditing standard that is the heart and the core of IFC. So a combination of IFC and ERM provide the desired assurance around vigil mechanism, so to speak. But there are interconnected peripheral elements of this framework. So starting with internal audit, statutory audit, the whistleblower mechanism or the whistleblower framework, forensic fraud prevention, forensic data analytics, cyber security or cyber events that could impact, compliance, and integrated reporting. And now, of course, the business responsibility report, BRSR, will also get added as part of integrated reporting. So these 7 elements of the framework need to have the arrows that you see. There is a two-way flow between the core and each of these elements of this core is what what we mean by what I am suggesting as an integrated visual mechanism. Today I'm going to talk about only this part, which is internal audit and CRM. Equally, there are integration elements between internal audit, IFC, between statutory audit, IFC, ERM. So this entire framework needs to be highly integrated for this to work effectively and for this to deliver the outcome that is expected from a very well-oiled, very well-integrated governance framework. So I'll stop sharing. I'll come back to the points that I wanted to talk about. Now, let me give you in 2 different buckets. What do I mean by integrating in the context of the framework that I just displayed on my screen? So when we talk about integrating the output of internal audit, so internal audit will deliver certain output as part of their audit plan. How can that output? How can those insights that come from an internal auditor's work act as a high quality input for the enterprise risk framework? So in this part, I'm going to cover that. I'll give you a few examples, or I'll illustrate it by way of covering or touching upon the elements of ERM framework. So again, the COSO framework for enterprise risk management has 5 or 6 key elements. I won't cover all. I'll just talk about 3 elements of enterprise risk management framework. The first one, which is around risk identification and risk evaluation, is a very critical element of the ERM framework, that the risk identification happens or should happen again at a process level, bottoms up as well as top down. And once identified comprehensively, the evaluation of that risk in terms of its inherent level of severity, possible frequency, and then how it has to be managed, how the response has to be worked out. All that is part of this particular element of the framework. Now here is where I see a huge contribution that internal audit can make. I'll give you 3 or 4 examples. While auditing the receivables, when the internal audit plan covers audit of receivables, in addition to other controls and the usual elements of report that will throw up many improvement opportunities either in the process or in the management of entire receivables as a bucket, the internal auditors can provide some very useful insights on the credit risk management. Because while the audit report probably talks about, okay, out of your 100 rupees of receivables, X amount is overdue, and out of that X amount overdue, there is a problem in these 8 accounts, and so on and so forth. But the big picture here is insights on the credit risk management will be extremely useful to be given back to the risk managers or the risk management team to incorporate in the entire either policy around how customer credits have to be managed and how the risk management around the credit profile of the customer needs to become better aligned to the realities, let's say external realities as well. Similarly, for NBFCs, for financial, whether it's NBFCs, whether it is banks or even insurance companies, a very key risk is around asset liability management, the ALM. So while auditing either investments or loans or liabilities that, let's say, financial services companies create, the internal auditors can bring some very useful insights on, is the entity carrying an ALM risk? Is there an ALM mismatch building up? Like I said, very critical for financial services businesses, and we've known enough examples in the recent past where the core reason why some of very large entities, somehow they got into major trouble is because of ALM mismanagement. And here is where, so while there'll be some regulatory requirements around asset liability profile management, but the testing of that, whether that policy, ALM policy, or the entire ALM practices, or what's happening on the ground. So the internal auditors can play a very effective role, bring it back to the management and say that, hey, you're building a loan book, but by the way, all your loans will be repaid in a longer term. You're financing them through CPEs, you're financing them through very short duration. Your assets are long duration, liabilities are, or vice versa. Similarly, while performing their audit, the internal auditors can identify governance risks. What's happening on related party transactions, for example, or what's happening around, let's say, even the whistleblower mechanism. How effectively is it getting practiced? Because the internal auditor will always be close to the ground. They will have their pulse on the business. They will know exactly whether the entity level governance policies are they getting practiced the way they are designed, the way the board wants them to be practiced or not. And if there is any learning opportunity or any opportunity for improvement that comes back in terms of a new risk that gets identified or a articulation of a risk that's already been identified. Similarly or equally, as part of risk identification support, internal auditors are best positioned to identify lead indicators that give enough insight on fraud risks. Is something building up, or are there enough lead indicators? And I was just very interested in what CA Premnath was talking about. We've got same PAN number used by multiple vendors. While that could be a simple case of master hygiene around SAP masters, it would also be potentially a fraud risk lead indicator. So these are a few examples that I thought I'll share how effectively an internal auditor can contribute to risk identification, which is an element of ERM, or help the first line of defense to effectively assess, evaluate, and then deal with that risk. So that's the first part. The second part, or the second element I want to cover is, of course, once the risks have been identified, assessed, evaluated, then the next most important thing is design a mitigation plan. Now, of course, that responsibility is not that of the internal auditor. That responsibility is of the process owner or a business leader, in order to ensure that the inherent risks starts to get managed effectively and the residual risks are within the risk tolerance or the risk profile, tolerance levels, and risk appetite. Now, while all this is something that the ownership of this bucket lies with the operating teams or the process owners, the way I see the role in this element, the role that internal audit can potentially perform is to do with, as part of their audit, they can do control testing or the effectiveness testing of the responses, whatever risk responses have been identified. How effective are they? Are they just on the paper, or are they being practiced? Now, for example, let me give you an example of currency risk management. So as part of currency risk mitigation, the treasury team will say, okay, look, we will identify whether we need to take forwards or we need to buy options, and at what frequency, and what is the portfolio level mitigation approach, how will the stop losses work, and so on and so forth. So there'll be a very comprehensive risk management policy or mitigation policy around currency risk. While auditing this area, internal auditors can study what the intended mitigation design was and how effectively is it operating. If it is not operating effectively, so this does two things. It gives valuable inputs and feedback to the risk managers that, look, your inherent rating could be high or very high. Is the mitigation action effectiveness aligned with what you thought you will do? Therefore, the residual rating, what gets presented to the risk committee or to the board, is it something that is aligned with the ground realities, or the assessment or the evaluation of the effectiveness of mitigation actions either overestimated or even underestimated, for that matter. So the internal auditor gives a very useful insight on that. Similarly, around compliance risks. So compliance risks, there will be a compliance framework, there will be some laws which will be identified, there will be a platform, whatever. But then effectively is the compliance, procedures, are the compliance procedures effectively being adhered to, and whether that throws up a different dimension of the compliance risk, which needs to, again, the board is responsible eventually for certifying that a compliance framework exists and it is effective. So that effectiveness testing serves a useful purpose, again, from the enterprise risk management point of view. And also with their experience, I always have believed that internal auditors should not hesitate from suggesting, though they are not responsible, but they should not hesitate from suggesting what should be effective mitigation actions that the process owner should consider, because they will be able to benchmark. Internal auditors will have experience and they are highly analytically oriented. So they should not hesitate. They should in fact come forward and suggest what should be an effective mitigation action. And then of course, it's up to the process owner to take it in the right spirit. So that's the second bucket within the COSO framework. So another one I want to talk about is monitoring of risks. So this is as a third line of defense. Internal auditor is in the best position to provide an independent assurance on the entire framework, risk management framework, the practices, the entire risk identification, mitigation action implementation, residual risk evaluation, also identifying opportunities, because this is the opportunity for internal auditors to contribute back, in addition to the standard audit report, to also say, guys, look, you are already managing this portion of the business effectively. If you manage this risk better, your business revenues, profitability, ROC, ROE can go up significantly, and those are the opportunities which internal auditors should be able to identify. So this is how I see internal audit playing a very key role when they integrate or they align their deliverables with enterprise risk managers' deliverables. So this is one dimension of integration. Now let me talk about the other dimension, which is how the work of an enterprise risk manager can potentially get aligned and integrated with the work of internal audit. So first and foremost, the audit plans, in my view, should always be, or as far as possibly, be identified based on the risk profile. So risk-based audit planning, which is linking audit plans with the outcome of enterprise risk assessment. Now, what do I mean with this? Let me tell you. So in every risk register, or at a maybe business unit level or portfolio level, there will be risks which are identified, and then they get rated at an inherent risk level, keeping into perspective the frequency and impact. Those are the two key variables, and different companies will have different rating metrics, but by and large, the frequency and impact matrix, the probability and impact matrix, impact on revenues, impact on profits, or net worth, whichever one you want to consider, gives a certain inherent rating risk profile. Now, the way I see this is, so obviously when you do this exercise, let's say you have a set of some 30 or 40 or 50 risks or 25 risks, probably out of that, some 8 to 10 risks will be rated, the rating will be high in terms of the inherent risk levels. And then there'll be few risks which will be probably moderately rated, and few risks which will be low rated risks at an inherent level. So the internal audit plan, my view is, should focus a lot more on the high rated inherent risk elements of the business or processes which are inherently rated high. And why do I say that? Because if there is a high rated inherent risk, then obviously the entire effectiveness of risk management of those risk items needs to be closely monitored by the first line of defense, the second line of defense, and the third line of defense, in order to make sure that it's all adding up when it comes back for a formal review by the board. The residual risk against those items is then carefully kept under a review perspective. So the objective, in my mind, should be to ensure that the audit of high inherent risk rated elements are considered, because those will be the ones which will impact the organizational objectives very deeply, because that's the reason why in the first place they got rated high inherently. The risk-based plan and the risk assessments, again, are the two important outputs of internal audit that feed into risk management. But then conversely, the entire learnings from the outcome of the key risk indicators, because the risk framework will monitor certain key risk indicators, those can be picked up by the internal audit team to weave back into their plans and also their audit actions if it is required. So therefore, the internal audit plan, in my view, can be prepared based on, firstly, criticality of the risk profile of the organization. How does the risk profile look for an organization, and how does the internal audit plan calibrate with that risk profile, and also risk appetite. What kind of risk appetite is an organization and entity demonstrating? Clear emphasis on strategic risks. So there'll be strategic risks, there'll be operating risks, there'll be normal risks, so a variety of risks will emerge. But then the key emphasis of internal audit plan, if it rotates around the strategic risks that are identified, and then what are the learnings. Now, this part I want to talk about a little bit more. Now, what happens in some occasions, quite a few occasions, the audit, the internal audit or the statutory audit, and the risk management functions tend to operate in two different silos. So that results in two major issues. Firstly, there is duplication of effort. It is possible that both might be looking at the same area, but both end up looking at it from a different lens, and there is duplication of effort to begin with. And the bigger issue is the issues that get flagged, let's say, in an internal audit report, might not get picked up seamlessly by the enterprise risk management team if the two are operating in silos. Conversely, the outcome from key risk indicators, if it is not picked up by the internal audit team, then the risk is that internal auditors either will try and do it all over again, or they may lose sight of some very valuable data points which are readily available in the organization. So here is what I suggest in order to avoid, and again, this is part of that integration that I was talking about. Effort should be made to build a repository or a common reference point, where the internal audit reports are available for the enterprise risk management team to refer to, number one. The KRIs, the key risk indicators, and their trackers are available to the internal auditors for them to review, so that then there is a very, very robust and a very real-time process of sharing the learnings by either of the two sets of, because they are performing different roles. Even in terms of lines of defense, they have a different role to perform. But this sharing and the learning sharing is very, very important. Also consider setting up an event register or an incident register, which can again be referred to by both sets of teams on a real-time basis, because that will be some useful, very useful learning. So, for example, in CA Premnathji's example that he gave, where these truckers are being used by multiple vendors, or you have PAN numbers which are common, etc., etc. When that's something that's a very useful insight for a risk manager or for somebody to perform fraud risk analytics and see whether it throws up any early warning signals, for example. But this is possible. The point I'm making, this is possible only when there is seamless sharing of information. There is a common repository, and now in a digital environment, all this is very easily possible to be done. So now, what are the overall benefits? What are the advantages that I see of this entire initiative by integrating enterprise risk management and internal audit? Firstly, huge value gets added by removing redundancies, duplications, and synergies that get created by the two sets of experts. Adds a lot of value. And again, the end objective, like where I started with, is to ensure that organization value gets created, strategic value gets created. So by aligning, calibrating, and joining hands, the risk manager and the internal auditor can collectively deliver a lot of value. That's first point. It helps to produce a common and an aligned view in front of the as far as the organization's risk profile and the audit opportunities, improvement opportunities emerging from the audit. When the interaction happens with the audit committee, because bear in mind, audit committee will always have a majority of independent directors or maybe entirely independent directors, and to do justice to the requirements or expectations of an independent director, it's very important for them to understand, to get a calibrated view of what are the opportunities as well as what are the areas where the organization's risk profile is potentially getting impaired or is under stress or likely to get under stress, and so on and so forth. So this aligned view will add huge amount of insights and value to the audit committee and therefore to the entire board, so that they can take all the relevant and timely actions to the extent they need to, in order to, from a governance point of view, in order to bring back the organization's focus on the strategic goals. Of course, there is learnings, leverage of competencies, roles, responsibilities. So this cross-pollination of information as well as learning sharing will do immense benefit to the profiles and the overall learnings of both internal audit team as well as the risk management team. A very important benefit that comes out is that the risk portfolio, the entire risk identification process becomes highly robust. So the risk portfolio that emerges for monitoring start to include risks which were not easily identifiable otherwise, because the benefit that an internal auditor brings is that of an independent pair of eyes, right? So a process owner, if he or she continues to look at their own backyard and the risks in that backyard from their perspective, it is quite possible there'll be blind spots. There could be, just complacency or whatever you want to call it. The risks may not even get identified. But if an internal auditor is supplementing those efforts, the risk portfolio is quite rich. It is quite robust and very relevant. That's the fourth benefit that I see of integrating this entire initiative. And last but not the least, there are always blind spots across the organization where there is not a readily identifiable owner of that particular risk area. And if there is a two-way flow of information, the internal auditors can bring on the table that, guys, look, these are 3 areas very critical to the strategic delivery. Your risk ownership is not clearly defined. While the business ownership, functional ownership might be defined, but the risk ownership may not be carefully defined. So you come across, plug this, and proactively fill them up. And so that again, the assurance on the overall performance, the assurance on processes, assurance on the performance becomes far better. So these were some of the thoughts I had in the given time frame. I'll be happy to offline otherwise answer or take any questions. But I wish everyone the best. It's a wonderful topic to cover, and I thank the Institute of Chartered Accountants for again having me to cover my thoughts on this topic. Thank you very much. Over to you, Vidit.
Thanks a lot. Thanks a lot, Neeraj sir. It was entirely a very wonderful presentation. I just listened to the COSO framework part and the visual mechanism part which you told, and the related topics which the knowledge which you infused and the experience through which you have told us. It was very amazing, sir. I was listening the presentation, and the way you connected it with the Premnath sir's topic as well. So it gave a lot of that information, connected information. So might be the speakers are different, but the information flow is from top to the bottom going on. Thanks a lot, sir. I hereby present a vote of thanks to you. Thanks a lot for sparing your time and deliberating for us, deliberating for the members. Moving on to the next part of our session, I would like to introduce CA Kanwaljit Kaurji. Her topic for today is risk-based audits. She's a FCA, Certified Fraud Examiner USA, Certified International Investigator, Committee Member of PhD Chamber of Commerce, Deputy Chairman of IIA Delhi, Member of Center of Audit Quality ICAI. She is a cyber fraud investigator, consultant and trainer, and have over 18 years of industry experience. Over to you, ma'am, for your deliberation.
Thanks. So good evening all, and it's my pleasure to get connected once again and sharing my thoughts. So something which has been already discussed with and go on. So I'll be continuing with the same topic in continuity of risk-based audit. Looking at my current profile and the kind of task I do, I can personally say that's something which is absolutely need of an hour. So by profession, since I'm more like an investigator now, I can say fraud is something which will never go out of fashion. And since last 2 years, something which has actually gone up is fraud. Everything else is slowed down due to pandemic. And that's where the demand for professionals who understand the risks, whether it is fraud risk or operational risk, is really, really high. So something which I would like to touch upon, where we'll say what exactly is risk-based audit, and also in a very brief time, I would like to also discuss what kind of skill set may be required. Many of us would have understood or listened to this term called risk-based audit, but not every time we really understand what is it all about. So let me just start with a very, very basic example of how we do internal audit. When we pick up audit universe, we think that we are doing risk-based audit. However, we are more or less focused on the processes of the company. So our audit universe majorly consists of more focused on processes rather than the risk. The core difference between an internal audit and risk-based audit is where our audit universe is majorly risk-based, where we have to really see what is the company's risk and do audit according to that. That's exactly the risk-based audit. The risk-based audit starts with 4 very, very important steps. Now, those steps are not for an auditor to take. These 4 steps are actually for management to take. However, we as an internal auditor has to really evaluate and see what is it all about. So I'll be talking about those terms in a very, very simpler term, more or less something which we can correlate with day-to-day operations of the company. So the first step, how it starts, the risk audit is entirely about how management perceive the risk. And this is not just about big corporates. It is about every type of business. Whether you talk about small shop owner, he's also a businessman. We talk about a CEO's chairman of the world's biggest brand. They are also businessmen. The concept of risk and business remains same. The only difference would be kind of risk they are exposed to. If company is too big, the risk could be geographical risk, could be economic risk, and so on. The business is too small, the risk may not be related to different countries, but they definitely are exposed to different kind of risks. So the risk-based audit can be done to any kind of business. Many a time I get a question from professionals as to our clientele or client base is not corporate. We don't deal with very big customer or big client. It doesn't matter. As I said, risk is everywhere. Risk to Spider-Man ko bhi lena padta hai. And that is where every business does take risk. And when business take risk, the need for risk-based audit arises. So the 4 simple steps which management need to take. The step number 1, risk identification. First thing a business has to understand it, what kind of risk they are exposed to. And that we do it via SWOT analysis. Strength, weaknesses, opportunities, and threats. S and W's are always internal. O's and T's are always external. So for example, if we talk about satisfied customer, the satisfied customer is a strength for business, which may convert into O. A one satisfied customer can get you 10 more customer. S can get you more into O. However, if you don't deal with the customer properly, the same customer will become threat for you. When we talk about government's policy, the government policy may be considered as weaknesses, a threat, or it could be O. Now, it entirely depends what kind of businesses we are into, what kind of operations we are in. So that's all about. When we talk about big infrastructure, by definition of it, we think that company with big infrastructure or good infrastructure is a strength, which may or may not be the case. There are a lot of classic corporate example where the big infrastructure has actually become a weakness for the business. It has become a white elephant. If company doesn't know how to use that infrastructure, then this is not strength. This is a weakness. Unless and until company does SWOT analysis well, they cannot proceed to any step ahead. Whether you talk about OSO's ERM framework, whether you talk about any risk management, unless and until company knows what is the risk and they identifies it well, every step is useless. It is management who has to see what is the risk. We as an auditor can support that in activity, but one, that it is not our core work. Secondly, management would know their risk better than as an auditor. If I'm running a business, I would know it better. However, auditor need to see whether management can perform the step number 1 properly or not. Risk is a good businessman is not someone who can see the risk which is right at the doorstep. A good businessman is the one who can see the risk few years down the line and work towards it. If risk is already at here, you have no option but to start dealing with it. But when we talk about risk management, company has to have good foresightness. Unless and until they see the risk ahead, they will not be able to manage it today, isn't it? So the SWOT analysis is very important step. Management need to perform that. However, auditor has to see whether they are doing it rightly or not, whether company has foresightness to see the risk or not. A quick example. There are biggest player in the mobile market. For example, Samsung, Apple, and many more. Nobody would have thought that Micromax can ever be a competition for them. Probably those global brands may have thought Micromax is too small a company to think as a threat. But we look at the market today. Micromax has a very good market share. Something, a risk which company could not see, and it is there now. Again, whether your client is small or big or a mid-size, every business is exposed to different kind of risk, depending on the industry they operate in, depending on the nature of work they are having. You have to support your company in doing step number 1 properly. And that is the biggest consulting activity we can do. Support with this step, where they can identify their risk well. Once the step number 1 is risk identification is done, we move on to the step number 2, that is called risk mapping. In corporate term, we also call it heat map. No matter how big or small business is, you just cannot deal with every kind of risk together. So we have to deal with most important risk first, then second and third. Let's put it them as low, medium, high. Basis their probability, basis their outcome. Something which has a very high probability to happen And if it happens, the outcome will be really high. This should be the top priority for the company to deal with. Then comes the medium, and then comes the low. But remember, what is low will not be low forever. Risk is not a static factor. Risk is an absolute dynamic factor. Something which you may not have seen or thought comes. For example, unfortunately, COVID. Not something which we could do much with, but just an example. When the countries were not prepared with the healthcare system, they had to take that heat. Or something which was impacting the countries, their citizens a lot. That's something, a risk mapping. So risk mapping is not just for the businesses, it happens everywhere, in every field. So risk mapping is nothing but prioritizing what kind of risk to be dealt with first, basis their probability to happen and basis their impact or outcome. However, whatever comes in the low category should not be considered as low forever. You don't speak to your debtor when they fall into 0 to 30 days. You don't give them a soft reminder to pay. They move on to the next category of M. 30 days have crossed, they have started defaulting. So low has converted into medium. You are still not so bothered about recovery. M converts into red color. And that is where they go into high. And we all understand once it crosses 90 days, it's very difficult to recover the money, isn't it? So low was not forever low. It has suddenly moved from low to high. Company has to see that. It could be anything. Could be debtor, could be a fraud risk. A big business, let's say $1 million or $1 billion business. They have a fraud of $1, $10. They think, come on, this is too small. Why should we bother about this fraud? Okay. What message are you giving to the company employees? That as long as the fraud is small amount, company is not bothered. So why not everybody, let's start taking $10 or $20 or smaller amount. That's called fraud risk. Because company never gave them a strict message. Company gave them a very clear message that as long as fraud is small, we are okay with it. Because we don't take any action on it. Not good. That is called risk mapping. So step number 1 was to identify the risk. Step number 2, to map it. See which risk is the most important to deal with first. Then to move on to second and then third. Once these 2 steps are done, it's time for us to take step number 3. And that step number 3 is to deal with the risk. We call risk mitigation. Now you know this is the risk. You know that this needs more attention. Now what next? The next is deal with it, isn't it? How to deal with it? There can be 4 important ways through which our risk can be dealt with. These 4 can be taken one at a time, all 4 together in any combination permutation, depending on what kind of risk do we have and what is the company's strategy to deal with it. So in short, we call that TARA. Transfer, avoid, accept, reduce. These are 4 ways we can deal with the risk. When we say transfer, we give our risk to someone else. Someone else could be an insurance company. Someone else could be in outsourcing. So companies basically transferring their risk to someone else. That is one way to deal with it. Let's say I can't manage that. So it's better to outsource to take an insurance. These are examples of transferring the risk. The another strategy is to avoid. Let's say I'm launching a mobile phone. I know a lot of competition is there in China. If I launch my product in China, it may never be successful. So let's avoid that. I'm not going to launch my product in China. Avoiding the risk. The third way is called reducing. How company can reduce the risk. Now we understand that fine, there is a risk. It's time for us to reduce it. Reduce it with innovation. Reduce it with better processes, better efficiency, better risk management. That is called reducing the risk. And the fourth step is accepting it. Now you know that risk is there. You just can't do with it. Hai to hai. Then we have to accept it. But accepting doesn't mean that be quiet about it and do nothing. Accepting is that see your tolerance. How much risk can you take? How much is your risk appetite? And once you know your risk appetite, then know how much can you deal with it and how you want to be dealing with it. That's it. That's called accepting the risk. With these 4 steps, we basically, so that we mitigate the risk. So that's called TARA: transfer, avoid, reduce, and accept. And comes the 4th step, last but just not the least, called monitoring. As I said in the beginning, risk is not a static factor, not something which comes and stay there forever. Probably there may be certain risks which will never be there tomorrow, or there may be certain risks tomorrow which was never there before. That is called monitoring. Whatever 3 steps we discussed, we have to keep looking at those steps again and again and again. And that's called monitoring, so that you will be updated. So these 4 steps called risk management. If you look at COSO's ERM framework, enterprise risk management, more or less, these are 4 steps which talk about that in COSO ERM as well. You talk about ISO 31000, more or less we talk about same thing again and again. So whether you talk about ISO 31000, you talk about ERM, you talk about any other framework or just risk management, it comprise only these 4 things, isn't it? Now these 4 things are for management to do. Remember, risk management is not the primary responsibility of auditor. It's a primary responsibility of management. The governance, which includes your leadership, your chairman, these people have to have oversight role. So into oversight role, they will see whether the company can manage their risk well or not. These 4 steps, what we just discussed, is something for senior management to take and get it implemented inside. And the auditor's role, the internal auditor's role, is to evaluate whether this risk management is happening or not. That is the risk-based audit. Where our focus is more or less about risk part of the company, we call it risk-based audit. Risk-based audit is not very out of word concept. We may be using it quite a lot these days because of higher risk in the company. But if you look at traditionally also, we were talking about control-based approach in audit. Yes, so there is a difference between control-based approach and risk-based approach. But when you see the inside risk of something, that's nothing but a risk-based audit, right? So as I said, these are 4 simple steps. Auditor has to simply evaluate it. If your client is ISO 31000, all you have to do is you have to comment. You have to comment whether the company is doing this risk management well or not. Otherwise also, the risk management is something which we had to evaluate and give our report on. At any point of time when auditor think that the company is not able to manage it well, or we need to do value addition, we get into our consulting role. As an internal auditor, our task is not just to report, but to do consulting as well. So that is where we get into the next mode of consulting and supporting them with better risk management. So remember, there are three words which are interrelated. GRC: governance, risk, and control. Many times we use this term, but we don't understand it much. What do you think is a correlation in these three? What is governance? Governance is nothing but the culture of the company. When we say internal environment, what is internal environment? Nothing but the governance part. If I'm sitting on the top of the company and I'm corrupt, there is no way the lower can be honest, but not other way around. Remember, ethics always flow from top to bottom, not from bottom to top. We talk about any kind of corporate fraud, talk about Enron, you talk about Satyam or any other. It happened at top. Governance, more power, and more exploitation of power. So what is good governance? When a company has ethical environment and good integrity culture, that is nothing but a good governance. And company is transparent, this is good governance. That is where we have a concept of corporate governance, which says the core of corporate governance is what? Transparency. Company has to be transparent with what they are doing, isn't it? So that is good governance. A company with good governance will have lesser risk. A company with good governance and lesser risk will have better control. That is how GRC are connected. Governance, risk, and control. Now, other way around. Governance is not good. Risk has to be definitely higher. When top doesn't know how to have ethical culture or good integrity, the risk will certainly go up. When the risk go up, controls will definitely be weaker. Governance, risk, and control. Now, this GRC is a concept which is important for auditors to understand actually at the first stage. When you are doing your audit planning and when you are actually doing engagement planning. Even before that, I would say, before accepting the engagement also. Understand GRC first. Then you would know what should be the scope of work. Otherwise, you may end up covering scope of work which may not cover the risk entirely. For example, a company's top thinks that in order to get any business, it's fine to give bribe. Now that's governance. When that's the governance, that's exactly the culture which will pass on in all the hierarchies below. Top says, you have to get the business. I don't care how you get it. Give bribe, do whatever you want, but I want business. Now, every employee at the lower level will start following it because they have to work here. They have to make their bosses happy, isn't it? They will start giving bribe. They will get into whatever wrong practices. What kind of risk is going up now? Compliance risk, regulatory risk, legal risk, and operational risk. Correct? Governance and risk. Now we can imagine what will be the structure of control in this company. Now decide your scope of work. So if you have to do your engagement planning and decide scope of work, nature, timing, and scope, now you should know how to decide scope of work. The first question is, do we really take assignment of this company first? Because the management's integrity plays very important role in task of auditor. And you will definitely get influenced by it, whether you want it or you don't want it. Or if not influenced, your independence will definitely get hampered here. So the first call, do we need to take this client? Call number 2, if yes, or you have already taken, then how to decide scope of work. Look at the risk. So here I'm not looking at processes. I have not checked any department as yet. I have not looked at their purchasing or manufacturing, anything as yet. That was my first starting point. Risk in the company. And from here, I'll pick up and do the audit. This is called risk-based audit. So a company definitely has their own way to manage risk, but as an auditor, we should do our independent evaluation. Now, whether you are doing it in certain framework or as per some standards, however, it should be absolute in-depth understanding of the risk of the company. Though as an auditor, we can't be expert in every industry. But my practical experience and practical suggestion here is, whoever is your client, whichever industry they belong to, spend some time, do good homework on them. Understand their business model. Even if it takes few extra days, that is something which will always pay off. If you will not understand the business model, you will never understand the risk. And client will always tell you कि sir ये तो ऐसे ही होता है, आपको नहीं मालूम होगा. And that's exactly where we get stuck. So I'll share a very quick experience of mine. I did my CA first time, and I joined a bank as an internal auditor. That was pilot batch by that bank, a private sector bank, where they actually hired internal auditor as an employee. Earlier, they were using third-party firms to do internal audit. So they hired fresh CAs like me, about 6, 7. Our head office was in Mumbai, and we were placed in various branches, various cities. However, we were introduced in the branches not as an auditor, but as an interns. Now, looking at our age and everything, it was very easy to tell them that these are interns. So we are curious, like why they've been not been told we are auditor, but of course we were too young, and of course we can't ask our bosses why. So for 6 months, we did all operations of the bank. I have sat as a cashier. I worked for treasury, so treasury function. I've made FDs. I worked as a cashier. Whatever functions you have in bank, we did for 6 months. After 6 months, we were called in head office once again in Mumbai. And that time, we were actually given the task to do the audit. And that time, our respective branches were introduced us as auditor. The fact is that since then, the branch managers and the employee of that branch start hating us, as we always happen to auditors. However, that's where we actually started our audit work. Why do you think bank wasted 6 months? They paid us salary and did not give us the work we were supposed to. That was an investment. After 6 months, nobody could tell us कि ये काम तो ऐसे ही होता है मैडम, आपको नहीं मालूम होगा. Otherwise, 6 months before, I may be a fresh CA, but then I did not know how cashier works. I could read 10 books, but I can still not know how this actually practically it happens. If I would have gone to cashier that day, would have told me, madam, you don't know. This is how we do it. And since they use so much of technical words, I may be easily impressed. Yes, he must be talking about it right. But now, till date, after so long, bank can tell me that this is how it happens. Because I know how this happened. That's called the grip of the business. So those 6 months were actually an investment by bank, not wasted. That is what I suggest to all the professionals out there, that whenever you do audit, especially risk-based audit, spend some time, buy some additional time from the client if you want. Maybe a week extra, whatever you think is appropriate. And understand the business model as if you have to do that business, so that you would know all kind of risk exposed. May not be 100%, but at least 70-80% grip you'll get on the business. Once you get that grip, nobody can tell you that this is how it should be. This approach should be adopted whether it's a risk-based audit or otherwise. That always gives us good hands-on. So that is my brief thing on risk-based. Now, in next few minutes, I would like to discuss a very important aspect as to what kind of skill sets are required. So that's another thing which we should know as a professional, that if we are doing something which is slightly different than what we've been doing, or something which we want to explore more, then probably we may need a little more skill set or little different skill set. Just because we are chartered accountant and we have done it once, no degree is sufficient for life. We have to always upgrade our skill set. We should always do that. I mean, CA is something which is going to be there with us for life now. However, it needs updation. That is why Institute conducts such programs for members. Keep upgrading, not just on financial skills, on a lot of other skills as well. So one very important skill which is required in risk-based audit is data analysis. Data analytics is something which I highly, highly recommend to each one of you. Whether you do it via workshops, whether you do some certification, it's entirely your wish, but do it. If you don't know how to do data analysis, how will you get into risk of the company? Correct? You will be lost in the data itself. How will you do a trend analysis? How will you look at the flow of data and know that something is not right here? Data analytics is something which is absolute a need. If you are not into it, please upgrade your skill set today itself. Start working on it. The another skill set which may be required, which is again with my practical experience both in the audit profession as a CA and investigation, is the communication skill. Here, communication does not mean your language of Hindi, English, or whatever. Communication skill also mean how professionally we talk and how good we are in talk. So imagine if I'm talking to somebody senior in the company and taking interview to collect more information, whether for audit or for investigation. So if I ask, have you done a fraud? What do you think the other person will tell me? Yes, I did. That will never happen. The only way I can collect information is getting engaged in conversation. So again, very quick example, again with my practical experience in the same bank, since I was new. In CA, we do read a lot of things, but nobody has actually taught us how to do bank audit, isn't it? I went to a branch. I went a little early. And then there was a peon in the branch, a very old guy. But he was there in bank for a very long time. Till date, after almost 2 decades of my experience, I thank him from core of my heart. I mean, I'm not in touch, but I still thank him wherever he is. Knowingly or unknowingly, he taught me so much. And he talked about so many things in the bank which no branch manager or nobody senior would have told me. For example, what actually happens here, how the files are actually processed here. Since he was senior, he was working as peon, but then he knew a lot of stuff. And that audit was really successful audit, being very initial audit of mine. The only thing which my capability was, I engaged him in conversation. That's it. Otherwise, I did not know anything about that branch operation. All you can do is check the papers, and papers are always perfect. But that peon actually told me the real story. And actually, I started my risk-based internal audit basis his feedback. I did not waste time looking at papers. Whatever I got in information, I started my work from there. That's how I call it communication skill. So please work on that part. You have to be people's person. People should feel comfortable talking to you. If you really want more information, people should feel comfortable to talk to you. Don't try to pose yourself as a threat. I am an auditor. It won't help. It won't. If you have to really get an information, get into informal way, friendly way, collect more information and then do your bossy thing, it's fine. So that's something which I have personally experienced and I can vouch that this works. So work on that part. And apart from that, when I say communication skill, it also is that how we write our reports. When you look at Big Four reports, you may be sometime wondering why Big Four charge so much when we do the same task and we don't get a fraction of what Big Four get. Of course, brand value is there. I can't deny that. However, brand value has developed over the years. And why brand value is it? Because if you look at the report, you will understand the difference between you and them. Same audit, same auditing standards, same tools and technique. The difference is how they present. And we as a small firm always cut corner in presentation. We keep giving gyan just like that only to the client. Do this, do that. Client understands and client says, okay, we'll do it. Why can't we do it in writing? Do it in such a nice manner that client will be forced to listen to you in a proper manner. Correct? So start working on it. It will be definitely helpful for you, not only professionally, but getting more assignments also. Don't give gyan to the client just like that. Okay, do this. You're talking about internal control now. So get an assignment for internal control. So for example, just on the lighter note, some firms write such a strong recommendation and technical recommendation internal audit that client says, "Ki humse to nahi hoga, aap hi aake kar lo." Now that's called setting the internal control. Now we as an internal auditor cannot set internal control. However, you can always have other firms which can go there and set internal control for them. You can go and do audit. Win-win for everyone. And not just for you as a business, it is definitely very helpful for the client also. Client think they may be able to do it, but they may not. They need your support. Correct? So this is how we can go about our internal audit. And again, since I get this question in almost every kind of session where people think that all this is only good for metros, and since we are sitting in metro, like I'm sitting in Delhi and I'm talking about it, no, it doesn't mean that we are only talking about big banks or corporates. Even if you are into small town, it doesn't matter. Lala ji ki dukaan bhi ek business hai, and Apple bhi ek business hai, and Samsung bhi ek business hai. And every businessman only and only understand two things: how to increase profit, how to reduce cost. That's it. Everything else is round and round and round. If you can tell your client how you can add value in increasing their profit and reducing their cost and losses, that's it. The client is convinced. Holds true for a businessman, holds true for the Lalaji also. Simple. So this is how you can get into this. So I think that's enough of gyan from my side. And so with it, I'm not sure if these guys can ask question on real time, but if they can, I'll be happy.
Now we are proceeding towards the question answers only.
Sure.
I'll just open the panel and there are pretty questions which are asked by the participants. I'll just give me a moment, ma'am.
Sure.
Okay, so the first question is, to what extent management can limit the scope of an internal audit when it is mandated by statute? How such limitations need to be disclosed in the report particularly?
So when we talk about risk-based audit, we basically talk about internal audit, which is more like a mutually agreed between management and an auditor. So I'm not sure whether auditor can force them to get into it unless and until we are talking about specific clause or specific standard. But more or less in internal audit, it's more like a mutual agreement between management and the auditor. What auditor can do, suppose management is reluctant to get into that or they want to limit the scope, maybe auditor can give them more logic as to why they should go about it. And as I said, you can always tell them that if this risk is not taken care, your profits will get impacted. Probably that could be one of the way.
The next question is, what is difference between 90-degree and 45-degree in risk?
Not really something I've dealt much with.
Okay. How to pick the risk without either doing the process mapping or knowing the process?
No, so that's something which I've already answered. Process is something which you have to definitely understand. So when I say understand the business model, you'll understand the processes also, that this happens first and this second and so on. So process map is something, don't go by SOPs and process map given by the client. Understand it in your way, how it should happen. As I gave my practical example, that once I understood that cashier should do this, I understood the process map. All I have to do is cross check with their SOP.
Right, ma'am. Next question is, people are at the core of an entity. Hence, HR policy should be a major area for internal audit. Correct or not?
Yes, for sure.
How productivity of the entity needs to be addressed by the internal auditor?
So that more of an operational audit, what I think you're discussing is looking at the effectiveness and efficiency of the operation. So for example, a company has a machine which can produce, let's say, 100 units a day, but the company only produces 70 or 80 units a day. But there has to be reason that why there is a shortfall. That is where auditors can see that efficiency should be improved like that. And so is effectiveness.
Right, ma'am. Next question is, what matters the most in the designing a system of internal control of an entity?
Risk.
If possible, could you please explain something about risk maturity and how can we frame in our risk universe, or will it be done outside of risk universe?
Correct. So a very valid question. Risk maturity model is something, or a maturity model of audit is something which should be definitely an integral part of your risk-based audit. First, look at the maturity model, see where we are, and from here start your risk-based audit. It's a very, very important aspect of it. It is not outside, it's very much part of our internal audit. I mean, I would rather say this could be the initial points where we start doing our engagement planning and deciding scope of work.
Right, ma'am. Next question is, please advise how to rate risks as high, medium, or low. How to measure the impact of an identified risk. So
this is a step which actually management has to take, right? Since we are not into that business, what is the highest is something only business can tell you. However, when you do the audit, or let's say you've been doing audit for that company or industry for long, you can definitely add on with your experience. But that step is majorly for the management to take. For example, let's say a company has 5 types of debtors. Now, we as an auditor would not be an expert to know which auditor is more risky than the other, or who does more default than the other. Only business can tell you. So this mapping is majorly done by company, not us. Those 4 steps what we discussed is for management to take. We have to evaluate it.
Right. I believe it is difficult to put a counter measures for residual risk. Could you provide an example practically?
You are absolutely right. Residual risk is something where most of us believe that this gonna be there and we accept that risk. So yes, it is difficult. Now, what is the extent of residual risk is something. My suggestion here is that as an auditor, we should see how much is the appetite for the company for residual risk. And when we decide the sampling part, how much precision is required. Now, if I'm fine with 95%, then 5% is residual risk. And I have to be okay with that. But if I'm a bank, then I may not be. So that depends.
How to calculate risk appetite in a quantitative method? How practically we can evaluate risk appetite?
That's another thing which you have to do it along with the management. Appetite is not just in the quantity, it is more about the mindset also. So for example, a business who are into traditional family business, they don't want to get into implementing ERP, for example, or SAP. They said that whatever we are using is working good. That is something, because they don't want to take any risk. Now that's more about mindset. A business is too big, but you can't do this, because that's more, it's not about quantity, it is about mindset. So risk appetite is a mixture of both quantity as well as the mindset, attitude towards risk.
When in course of internal audit, the internal auditor comes across some irregularities which are not in his scope of work assigned to him, whether he should report those irregularities to the management or not.
So in that case, ideally, we should get our engagement letter or scope of work modified. So I'm sure this is something which you may have come across during your audit. That time you should discuss it with management or leadership, depending on the case, and get your scope modified. If client is not interested in getting it done, then reporting should not be done, because that was never part of your scope of work. But if management is convinced, the scope of work will be modified, and then you should definitely report. But if it is a fraud risk, then you should report, whether it was scope of work or it was not.
How an auditor can link ethics with the risk management?
Governance and risk, I think I've already answered. Absolutely go hand in hand. Integrity and governance is one of the same thing, right? So when we say internal environment, this is nothing but integrity and ethics. And it absolutely goes hand in hand.
Whether risk management is part of auditing or it is separate discipline?
Sorry, come again. Risk management is?
Whether risk management is a part of auditing or it is a separate discipline?
No, so it's a part to be done by management. Our task is to evaluate the risk management. We don't do risk management. We can't.
Is there any audit standard, act or other source that clearly lays down the reporting relationship and responsibilities between an internal auditor of a parent company and internal auditor of a subsidiary company?
There are standards. I'm not sure whether in India, I have to really check, but in international auditing standards, there are auditing standards which clearly laid down how has to do it. So maybe I'll just check that particular part and get back to you. I don't remember that ISA as of now, but then there is.
Would it be correct to say that more than legal compliance, focus should be on efficiency and profitability?
The answer is no. We should have to balance it both. If legal compliances are not happening, company will not be able to operate, and efficiency and effectiveness will be definitely zero.
Rabia is now introduced. It is something related to banking. Shall I ask this? I don't know. It is not related to the risk. But if there's a question, Rabia RBIA is now introduced for NBFC HFC by RBI. Could you please enlighten something about it?
Maybe not something which I don't know.
Is CFE a good certification in India for internal auditors as regards its scope today?
For sure. I'm a CFE myself, so I can vouch for it. It is one of the most prestigious, not just in India, outside India as well. So for sure, you should think about it.
Right, ma'am. I think I've asked all the relevant questions. People rest are asking about sharing the presentation.
So I think that's all from my end. Vidit, thank you so much for having me, and I wish you all the best, all of you who are there as a participant. I'm sure you'll have a very bright career ahead in risk-based audit. So thank you so much.
Thank you, ma'am. I would present a vote of thanks. Thank you for providing such an amazing and nourishing deliberation on the topic. I believe every participant who listened to your presentation must have learned something new today. Plus, the way you told about the TARA, GRC, right, the approach to the audit, plus your practical experiences of that Tune one, which helped you learn, figure out your first initial audits. So it was very much amazing, ma'am. Thanks a lot for sparing time and being with us. Thanks a lot.
Thank you so much.
Thank you all the participants. We here right now the questions have been answered. We move towards the end of the session. Thank you for sparing your valuable time. Thank you. Have a good night.